Today, we sit down with multiple insurance experts to find out what's happening with insurance in California. And we also get some tips on improving the insurance policy plan with as little possible.
Some of the fire victims, they're getting 20% less than the value of their homes.
Absolutely, and 20% may be a good deal. Okay.
Wow.
Lots of people get a lot less than that.
You started to see massive FAIR Plan growth. And you don't want massive FAIR Plan growth. You're going to pay more and you're going to get less. That's the market of last resort. If the FAIR Plan runs out of money, there's no state bailout.
I'm Siama Korami. Welcome to California Insider.
Rex, it's great to have you back on. Welcome back.
Thank you for having me back.
There's a lot happening with insurance in California, and you represent the industry on the home side of things and on auto. A lot of people that got impacted in California by the fires, they're realizing that they're underinsured. They don't have enough to cover for the losses that they got. What are your thoughts on this?
Well, it's a chronic issue. It's not the first time, and I'm sure this won't be the last time we have to deal with this issue. It really has a history to it. In the late 80s, we had the Oakland Hills fire, and at that time, the average insurance policy was called a guaranteed replacement cost policy. And the nature of that promise from the insurance company was that no matter how much insurance someone purchased from the insurance company's responsibility was the same. They have to rebuild that home to pre-loss condition. And at that time, we used to get sued for what was called overinsurance, where people would allege that insurance companies were forcing them to buy too much insurance because they knew even if they bought less amount of insurance, the insurance company still had to repay their home. And so after the Oakland Hills fire, when we had these guaranteed replacement cost policies in the marketplace, we had our first elected insurance commissioner, elected in 1990, and it was the first time we had an elected insurance commissioner just really beat up the insurance companies to pay well beyond what they thought was the amount they should have to pay. And they did. They paid several $100 million more to rebuild those homes than they thought their contracts required. Now, that made a lot of people happy whose homes were rebuilt, but there's a consequence to that, and the market moved away from what was called guaranteed replacement cost, and the nature of the insurance contract completely changed. It changed to what's called a limited replacement cost policy, where people buy a certain amount of insurance, and you know in advance what's the maximum amount an insurance company will pay. So it's no longer guaranteed to put your home in a pre-loss condition. It's you buy a certain amount of insurance. And so that change to a limited replacement cost policy really was a reaction to the way the state had handled the aftermath of the Oakland Hills fires. So then what's the nature of the promise when there's a limited replacement cost policy? It's that an insurance company will rebuild your home up to a dollar maximum. And so then how do you figure out what that dollar maximum will be? And under California law, the one person that has a choice of how much the insurance policy will be worth is the customer. The insurance company doesn't choose that amount. The customer chooses the amount of insurance. And so what does that process look like? So typically, someone who's shopping, they have to be aware of what construction costs are like in their area. Is it going to cost $300 a square foot to rebuild your home after a fire? $400, $500? What's the right number? Well, again, California law says the insurance company controls all aspects of the drafting of a contract except one thing, and that's how much. How much insurance is involved, and that's the customer's choice. And so an insurance agent sitting at a table wants to be helpful, and what's the way that transaction goes? They might say, well, how much do you want to buy? And a lot of people might not have any idea what it costs to rebuild a home. And
Because
so
it's not really the cost of the land or the value of the house.
it's not the market value, it's not the cost of the land, it's what would it cost to have someone come onto your property and rebuild that home after you lose it. And typically, a lot of people will say, I don't know, how much should I buy? And the agent will say, well, that's your choice. We do have access to estimator tools that can show you what houses in this area typically cost to rebuild, given is it all custom? Is it tracked? Does it have granite? Does it have linoleum? You know, they go through and these tools that you can use will give you a replacement cost estimate. And insurers are permitted under California law to say, well, we subscribe to this service and here's what their data suggests, but use that as a starting point in making your decision. And then people have to make that choice. And so you can imagine at the time of sale, people probably want to pay as little as possible. But then their house is burned down and they want the biggest possible claim check that you can get, because what happens after a mass fire, if it's not a one-off home kitchen fire, let's say, if it's a mass event where 1,000 or 2,000 homes are burned, there's just not enough contractors to go around, and so prices go a lot higher. And there are features in insurance policies called extended replacement costs that will give an extra percentage beyond the amount of insurance you've purchased if it's a mass disaster. And that feature is designed to help deal with demand surge. But there still are circumstances where you have unbelievable prices. Like look at what's going on in Los Angeles right now. The prices between Altadena and the Palisades will probably be different for what it takes to rebuild a home, but we're hearing of bids of $1,000 a square foot to rebuild a home in the Palisades. Well, what person would have bought $1,000 a square foot amount of insurance? So for a 1,000 square foot home, you have to buy $1 million of insurance coverage? Who would have done that in advance, right? And so it's a hard issue, because we do sell limited replacement cost policies for a reason, because of what has happened in the past. And so it's just critical for people when they're making this important decision about their most, probably valuable asset that they hold, take seriously the decision you make up front about how much money do you want available when disaster strikes.
On the fires, we also heard from some that it's confusion about the smoke damage.
Yeah.
Some people are not getting as much as they thought they would get from smoke damage. And what are your thoughts on that?
It's a tough issue. So the standard form fire policy, so California law says what exactly must be included in every fire insurance policy sold. And one of the things the fire insurance policy must cover is smoke damage. Now, the law doesn't say exactly what that means. It just says, hey, insurance companies, you have to cover smoke damage. And that's in every policy. And so, imagine a big fire like we just had this year. And there's a lot of wind, we know, because it was heavy windy conditions. And now you've got smoke and ash that can travel a significant distance because the wind is so heavy. And so you could have homes that are 5, 10, 15 miles away that are nonetheless inundated with ash, and smoke goes through the home. And it's clearly a problem that the insurance company should adjust and pay. Now, not every smoke claim is created equal. There are some smoke claims where it's obvious this is a home that wasn't burned down, but it's very near where the fire was. There's ash everywhere. Every nook and cranny of the home has smoke damage, ash. And in that case, it's a pretty easy call for the insurance company. You really need to clean that place up. At the other end of the spectrum, we have examples where people might be 25 miles away and the wind wasn't even blowing towards their house on the day of the fire, and they don't make a claim until just before the deadline to make claims. And in fact, a bunch of people make the claim at the same time because there's lawyers or public adjusters who send a postcard out saying, hey, don't miss your chance to file for a smoke claim due to that fire a long time ago. Now's your chance. And then companies will get a whole bunch of claims from the same area all at once, very late in the game, very far away. That's a less, that's a less likely to pay type of claim versus the one where they make a claim immediately. It's very near the fire and it's no doubt. Those are the two ends of the spectrum. And so obviously most of the cases are in the middle, but each one of these situations is very different for companies to figure out how should they react. Now, a lot of people, it'd be easy for them to say, just pay the claims. Well, we can do that, but then you have to step back and say, what is the system cost associated with that? What does it mean to pay the claim? Does it mean you do a wipe down and a steam cleaning? Does it mean you have to take the wallpaper off and put new wallpaper in? New living room set? Does it mean you need to completely change the HVAC system so all the venting and tubes are different? What is the level of cleaning is a hard decision that there's no law, there's no language in a policy that answers the question. Most of the time, these smoke claims are settled because you have people of goodwill who just want, a policyholder wants a fair resolution, and the company wants to make sure that they're not spending too much on every claim such that their losses go way up, and then they have to go to the Department of Insurance and ask for a rate increase. And now, if we pay too much on smoke claims, then the whole policyholder base is going to have to pay a lot more for insurance. So there's a trade-off here. The more we press for smoke claims to be paid when they're questionable, not the obvious case, those claims get paid. But the cases where they're questionable, then we have system costs go up. What should be required to use some diagnostic tool that analyzes the microbes, down to the point where it's a $10,000 exam that you have to do, and now the cost of insurance claims go way up and we all pay more. Those are sort of the balancing items that I think we all have to figure out as a society, and certainly the Insurance Commissioner's Office is trying to figure out what's a fair resolution so people get value out of their insurance policy, but we don't have claims costs that overcompensate in situations where you have to do a bunch of cleaning or a bunch of replacement of property that's not really necessary, and it drives up the cost for everyone. Because there's no doubt the price of insurance is going up, and while California, relative to the rest of the country, is still not an expensive state, the average premium in California is about 20th highest in the country. If you are in Texas or Louisiana or Florida or even Colorado, it's significantly higher on average to buy homeowners insurance there. But nonetheless, our prices have been going up over the last few years, just because the losses have been so big and companies have had to deal with inflation and other things that drive up the costs. So while we're dealing with premium increases now, you have an issue like smoke claims come up, and there's a trade-off here. You want to make sure people can live in their home, and particularly if they've got some type of respiratory condition where they really need additional resources to make sure that smoke is not going to harm them. But if we go too far and make the cost over expensive and we over replace things that aren't really needed, then all of our prices are going to go up. And so the Department of Insurance currently has a smoke claims task force, and it's got all parties represented. And hopefully we can come up with something that takes care of the people who need to be taken care of, but do it in a way that doesn't just lead to even more price increases on the average person.
You mentioned that every time we have these losses, prices would increase. How does it work? Doesn't these insurance companies make profit? And sometimes they take risk, right? Does it have to always turn into price increases?
Under the old system, it did. That's the way the regulations were drafted. That's what we objected to, and we've asked for 10 years to update our system. But under the old system, the way it worked is the price an insurance company could charge was based on, in part, what their historical loss experience is. And so when you have a big event, you pay out a bunch of money, then the way the department's rate formula works, you would have a higher indicated rate, and you would go to the department and you would get permission to charge more. And we don't believe that is the sound way to at least look at catastrophic wildfire, because we had a system that said just take the average losses paid out over the last 20 years, and if they go up, then you get to charge more. If they go down, you have to charge less. And insurers were keen to point out every other state has rejected that. And California was the last state to hold on to that method. And technology has increased, and companies they now have access to more complicated catastrophic models that help them predict in the long term what type of rate level that they need. And so finally, in the last year, the state of California has allowed companies to use forward-looking models that look at where the homes are that you're insuring, what's their building quality, what's the proximity to fuel, what are the wind conditions there, and you can start to prepare better to take care of those future losses. Now, importantly, when you use those models, they're not based on historical experience, so if you have a big loss, it doesn't change your rate need. It doesn't change what you can show to the Department of Insurance that you need to charge. And so it gives stability. And so in all likelihood, you're going to have some price increases to get up to where the rates need to be, but then after a big fire, rates don't change. So those regulations are just done this year under Commissioner Lara's sustainable insurance strategy, which is a really big reform. It was the first modernization of insurance regulation in several decades. And so the Department of Insurance took 2 years to draft extremely complicated regulations. And when I say complicated, as someone who's had to read them all, very, very complicated. But it took 2 years to draft and finalize those regulations. And I want to say at the end of July, they were available for companies to finally be able to use. And so we now have 5 insurance companies that have made commitments to write business in higher risk areas if they get to use these new tools, both these forward-looking models as well as use an approximation of their cost to pay for the reinsurance that they have to buy, which we can get into what that is. But importantly, the state said, okay, insurance companies, we'll modernize the way that we allow rates to be made, and we'll catch up, frankly, with the rest of the country, because we were the only state that did it this way. But in exchange, you have to make sure you stay committed to high-risk areas. It's a quid pro quo. You want access to modern rating tools, you have to write business in high-risk areas. And so it's not as if our members loved that. You know, they believe they ought to be able to price accordingly and not have to make those promises, but that's not what the state offered. And so we now have 5 companies that have taken the state, up on that. The first company was Mercury Insurance, and other companies you may know, USAA, and other companies have now filed under these new rules. So the Department of Insurance is starting to review those filings, and hopefully they get done. And the faster they get done, it'll give the market more confidence that the Department of Insurance is serious about this new system. And then if you make a filing, you'll be able to get a faster approval, because those approvals can drag on. They can be 6 months up to a year or even more. And so it's hard if you have to wait a year to change your prices. And so my hope is that the Department of Insurance will be able to conclude these filings quickly and show the marketplace that they're serious about this new system, and they're serious about setting the conditions so that companies can return to this market, because right now we have unavailability that's unacceptable, and too many people are going into the market of last resort, the FAIR Plan.
Is the insurance industry back, and is it recovering? Can we say the crisis is over?
I don't think we can say the crisis is over, but I would push back a little bit and say it's not that the insurance company's back. The insurance company, other than 2 companies, never left. Every insurance company in the marketplace, except 2, have remained this whole time, but they've restricted where they can do business. So none of them left, but certainly some of them started doing business in lower volume in high-risk communities around the state. And it was really a dispute about what's a proper price they're permitted to charge under our rate laws versus where can they do business. If you have a high-risk clientele, but you have a rate level that's not going to support the claims that come out of those areas, you're going to go bankrupt.
Were they losing money? In a sense, you came on and you shared some information with us that
things changed starting in 2017. We had both Northern and Southern California fires that were devastating. And then in 2018, we had a repeat, both Northern and Southern California. And 24 years of underwriting profit was gone in 2 fire seasons. And so after the first year, after 2017, there was not a huge market change. That's the nature of the insurance business, particularly when you write catastrophic wildfire. You know there's going to be many years of no fires, and you're going to be profitable, but you're really like a squirrel putting away nuts, waiting for the tough times. And that's the nature of doing what's called low-frequency, high-severity insurance. That's what catastrophic wildfire is. You collect money for a long time, and then you pay out a whole bunch of money infrequently. But you have to collect money during those good years in order to be ready for the bad. So after 2017, I think most insurers just looked at it like, wow, that was a terrible fire year. And they knew, because both the Northern and Southern California fires were caused by utility infrastructure, that after they paid the claims, they would get some of the money back from utilities. They never Insurers never get 100% back from the utilities after a big utility fire, but they might get 40 to 60% back. And so they looked at that and said, wow, this was big. It cost a lot of money. We're going to get some of it back over the years, because it takes time to get paid back by those utilities. And then they just moved on. But then when it happened again in 2018, and they were utility related, that did change the market. I think at that point, insurance companies looked at, well, our rates are pretty low because they had been held down by the previous insurance commissioner, Dave Jones, for his whole 8 years as commissioner. And so you had rates that were relatively low. Then you had 2 years in a row of these utility fires. And I think companies started to wonder, is this sustainable? Can we get, under California's rate rules, can we get enough rate approved? And what's going to happen if these fires keep happening every year? And are utilities going to be able to get their infrastructure under control? And you see in really May of 2019, is if you dig into the data, you can see that was the first month where the FAIR plan started to grow, 4% in a single month, May 2019. And I think that's when companies started to really doubt, do I understand what's going on in California? Is this a viable marketplace? Can I get adequate rate? How are we going to deal with these utility fires? And you started to see companies pull back. Now, 2 companies left. One only really catered to high net worth clients, so their population was very small, and the other was just a small company. But other than that, every single insurance company has stayed. But it took a little while for the slowdown in the market to really get the attention of policymakers. Initially, it was just a lot of people in rural areas. California being a blue state, a lot of the problems were in red counties, so that got a little bit less attention in the legislature as well. And it wasn't really until, I would say, I guess it was the spring of 2023, when State Farm finally announced that they were going to stop writing new business. That's when policy...
Completely, like they want to...
Yeah, they would keep their customers, and they're such a big company, they write 20% of the premium volume. So it's a big deal if the biggest market player can no longer take new business. So they stopped taking new business. Now they kept, the vast majority of their customers, but they stopped writing new business. And then the next week, there was a San Francisco Chronicle article talking about, well, all states done the same. The largest publicly traded property casualty company in the country. A week later, you have news, not just that it's State Farm, but it's Allstate. And after that, I think legislators really started to pay attention. Governor's office really started to realize, wow, we have a problem here. We can't have these big national names that everybody knows not writing new business, because who's going to pick up the slack? And so the second largest company, Farmers, was just inundated with applications the month after State Farm's announcement. And so they eventually had to put a cap on how many new policies they can accept, because as you take more business in, you have to have more capital to support that growing business. And where do you get that money? You have to buy basically insurance from another insurance company, what's called a reinsurer, in order to shore up your finances. And that is expensive to do. It can be expensive. And so Farmers had to then put a cap on its new policies to 7,000 policies a month. And who else is going to take that? After State Farm at 21% and Farmers at 15%, the next largest company is 7 or 8% of the market. So once that dynamic started to happen, you started to see massive FAIR plan growth. And you don't want massive FAIR plan growth. You're going to pay more and you're going to get less. And the FAIR plan, for your viewers that may not know what it is, it's the market of last resort. But it doesn't have a huge amount of regulated capital that the Department of Insurance monitors and says, oh, you need more capital. It has the money it has. And the way the FAIR plan is designed, it's not a state program. It's a private association that every insurance company has to join as a condition of doing business in California. The statute says it's a private, non-voluntary association of insurance companies. And so every company doing business here must be part of the FAIR plan. If the FAIR plan runs out of money, there's no state bailout. The insurance companies have to take money out of their coffers and give it to the FAIR plan. So the more the FAIR plan grows, the less it's able to deal with a massive fire, then the more likely the fair plan is to run out of money and turn around to the insurance companies and say, hey, you need to give us money. And then the insurance companies turn around to their customers and say, we need to recoup this money, or else if we keep getting fair plans assessments, it's going to bankrupt us. And so pretty soon we have a system where you have an underfunded fair plan with too many policies, and insurance companies recovering that money from their customers, and you have low and medium risk customers starting to subsidize fair plan business. And that's not viable.
So the people have less risk they have to pay for.
They'll get surcharges on their insurance policies. Absolutely.
And this has happened already, right?
It happened with the LA fires. The fair plan, they assessed the insurance industry $1 billion after the January LA fires. And so under the law, the insurance companies, they have to just pay out of their own finances half of that. So the insurance companies had to eat $500 million of loss out of their surplus, which makes them less strong, but they're permitted under the law to turn around and take that other $500 million of the fair plan assessment and add that to their policy statements and collect it from their customers.
And that happened this year.
Yeah.
That happened this year. Is the fair plan still growing?
Fair plan, last statistics I saw, it's 22,000 policies a month. You know, the historical resting point of the fair plan, it was created in 1968. The historical resting point is about 120,000 policies statewide. That's where it, 120, 125,000.
These are the riskiest things that nobody want to insure, right?
Yeah. In the late 60s, when the legislature created the fair plan, it was really a Southern California brush facility. So think Topanga Canyon, Malibu Canyon in Los Angeles, where there's no access by fire trucks, and you've got all this dry bush, and you get the Santa Ana winds rolling in there, and you have massive fires. That's what the fair plan was designed for. And really it was, Ventura, San Bernardino, Orange, San Diego, LA counties. That was the dominant policyholder base of the fair plan. Well, that started to change in May of 2019. You started seeing fair plan growth in the Sierra Nevadas, in big alpine territories. So now it was no longer a sagebrush, oily kind of creosote bush facility that the fair plan was looking at. You have a bunch of giant trees, and you have a fire like in Paradise that is the most horrifying thing you can imagine, with fire that is unbelievably powerful and tall and can consume a community. Totally different kind of business. So the fair plan has been growing wildly in the mountains. And really its policyholder base has changed quite a bit. But importantly, for a facility that was 125,000 policies statewide, it's now over 600,000 policies and growing at over 20,000 policies a month.
So it's still growing very fast.
It's still growing very fast.
Meaning
Now,
people are still losing their insurance, essentially.
Yeah,
People
the last 2 years, the growth has been in low and moderate hazard areas. So most of the high-risk areas, probably those customers are already in the fair plan. And as the market has continued to have dysfunction, you start having people who really shouldn't be in the fair plan. They never were, they shouldn't be, but for a variety of reasons, insurance companies haven't been able to serve all of those customers, and their only option if they want to buy a new home, close an escrow, is to go to the fair plan. And it's an unsustainable growth that we have to stop. Now, under the commissioner's new regulations, we're happy to see 5 companies have made filings where they're going to write in higher risk areas, and they're going to be willing to grow. And the hope is that, again, if those filings are approved quickly and you can give confidence to the market, other companies will come into the market and say it's time to grow again. We have to have that growth, or else we're not going to start slowing down the fair plan policy count.
Now we go to Robert Anderson, who's an expert witness for court cases on insurance, on both sides, whether on the insurance company side and on the client side. He's going to give us some expertise inside this industry.
We have been hearing from some of the fire victims that they're getting 20% less than the value of their homes from insurance companies.
Absolutely, and 20% may be a good deal. Okay.
Wow.
Lots of people get a lot less than that. It's a real problem when you have a major disaster like the Palisades fire and the Eaton fires in Los Angeles. All of a sudden, everybody needs somebody to build a house, and there's only so many contractors out there, and they scramble to be able to get them. So prices go way up, typically sometimes 20 to 40%. Building codes get changed quite frequently, and I know there are a lot of places in California right now where maybe even have, depending on the area, even have sprinklers in your house, or you have to have special kinds of roofs, or you got to do all kinds of things. So when you go through a period of time, and a lot of houses, been around for a long time, those codes keep changing, and so when you're building the house over again, if you had a total loss and you had to build it over again, you've got a problem there because the codes have been going up, 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 and up. So the house you got to build to replace it is a house that's much different than the house you had originally because of all the code upgrades. The regular policy gives you like 5 or 10% of the value of the house for that. But I've seen many, many times when that value is 30 or 40% more because of the codes, and nobody really ever talks about that. And as a broker and so forth, they just sort of forget that. But you look, we had several fires in Santa Rosa right now. I looked at the various code upgrades. I was actually going to the various cities in Santa Rosa. In their thing, and actually see what the code upgrades were and how all like that. Over 25 or 30 years, it could be 30 or 40% more expensive house because of
to
code
rebuild
upgrades.
the same thing. You have to go through a new code.
Yeah. Yeah.
And how does that work in a policy? Because people get insurance, they assume that they're going to get what they have.
Well, it's be written. It would be like 5 or 10% would be code upgrades. Okay, so one of the things that I do is in testifying against insurance brokers, if I'm in that position or supporting them, and sometimes they're doing their job right, you have a situation where you could buy some things very, very cheaply. Okay, as an example, code upgrades. Okay, I have code upgrades on my house. I have like 40% more. It's the maximum I could buy. Okay, so that means anything that, and our house has been there for quite a while, so anything that's been changed and so forth that cost me to build something new, I could have bought that. It's like $300 or something.
So you can
like
buy
that.
it as a part of your policy.
Yeah, you could just, but they don't ask for it. It's not asked for, okay? Then the second thing is every policy has the ability to have what they call the extended replacement cost, which gives you more money to pick up the increased value of your house. But, it could be minimally 10%, but you can buy 20%, 30%, 40%, 50% more for peanuts. So in my particular case, I've got a 50% more than the house actually sort of presumably will be worth for this extra cost, and it cost me like $100 or something to get that on my policy. So there's lots of little tweaks in there that don't get explained properly to the customer because the agent wants to make a sale, and he's competing with lots of other companies with big names, and people just look at it, figure that's the right number, and it's almost always low. It's very unusual that a house would be insured for more than it would cost to build it. The amount of overinsurance is almost none. Nobody's really telling you usually about all these little things you could do rather cheaply to actually get the number boosted up for replacement costs without increasing your premium. So if you move from $600,000 policy to $1 million policy, whatever that percentage is, that's what you would typically pay. But you can get it other ways, like I was talking about with the code thing and with this something called extended replacement costs. Instead of paying that proportion on your premium, for $100 or something, you can get this, and people don't know about it.
So even though they have insurance, it's not enough and it won't cover them, but they could buy a little bit more.
Yeah, for nothing. Relative to the premium price, okay?
What are your thoughts on the FAIR plan?
The FAIR plan is a very stripped down policy. People don't have any idea. It basically covers fire insurance in California and, all the other things that might happen like vandalism or water damage or anything like that you typically get in a homeowner policy, you get fire insurance. And then the other problem is most agents don't really know what is in a FAIR plan. So I'm a State Farm agent, And I all of a sudden been told by State Farm, policy's coming up November 1st. We're not renewing that policy. So that agent who's never dealt with a fair plan before gets another policy for the same amount of money for the building, but doesn't realize, there's no contents coverage, there's no vandalism coverage, there's no water damage coverage, and there's a big long list of things that it didn't cover. A lot of people that got a fair plan policy just got the bare minimum, and all the other things that would be covered in their policy, they might not have gotten replaced. So there's a lot of confusion over that aspect as well.
Before we move on with the rest of this interview, let's take a look at some key headlines in California's section of Epoch Times newspaper this week. Governor Newsom admits that he is considering a 2028 presidential run. Transportation Secretary is taking away $160 million over illegal truck drivers that are getting licenses in California. As you recall, there's been 2 incidents of illegal truck drivers having accidents causing deaths. There's a big battle between California and federal government over this. California State Senator Scott Wiener is launching a campaign to unseat Nancy Pelosi. Now, Congresswoman Nancy Pelosi had planned to run for 2026 election. When we reached out to her for comments, her staff told us that she's focused on her role right now. There was a council member in Arcadia in Los Angeles County whose political consultant turned out to be a CCP agent. When you look at a story like this, what's happening in Arcadia, that we have been covering how the Chinese Communist Party has influence everywhere, not only in California, across the nation and across the globe. These are the type of stories that you only get them from the Epoch Times newspaper. We have a lot of insiders that give us information about what the Chinese Communist Party is doing in California, in the US, and across the globe. And we have brave reporters that are willing to put their lives on the line to tell the truth, even though they have had death threats. Make sure to subscribe to our newspaper today. You can click on the link below. It's only $1 for the first few weeks. And let us know what you think of the paper. The insurance companies keep asking for these increases, rate increases, and sometimes they're in double digits. There's a lot. Californians haven't been used to paying this much for insurance.
Yeah.
How can people ensure that these rates are fair?
Yeah. California is one of the handful of states that's called a prior approval state. In a lot of states, they're so-called file and use states where a company just tells the state, hey, we're going to increase our rates, we're filing our plans with you, just wanted you to know, and then they move on and increase their rates. Well, California, we don't operate that way. In a prior approval system, a company is not permitted to change its rates until it makes an application with the Department of Insurance and gets an approval. And until then, you have to stay at the rate that you're currently permitted to charge. And so the prior approval system is governed by a very complicated set of regulations that I assure you, your viewers, could not make it through a page without falling asleep. It's very complicated. Imagine every conceivable component of an insurance rate has been reduced to dozens of pages of regulations. And so there's a pretty rigorous rate approval process where in the old days when you would file paper applications, it'd be thousands of pages. And you would file them in a filing office in LA or in San Francisco, and they were giant. Now at least it's an electronic portal where you can submit this. But the justification behind each rate application is stunning. Certainly, if not the most rigorous in the United States, in the top.
So you have to explain why you're...
You have to explain what's your expense. You have to explain what's the commission you're going to pay agents, what's your overhead, what's your advertising, every single component. What do you expect your claims to be? And that's where actuarial science comes in, where you have to say, what's the frequency and severity of future claims? If it's a highly inflationary environment, you're going to go to the department and say, hey, we need higher rates because we're going to be paying more to repair automobiles and we're going to be paying more to rebuild homes. Or if the economy is really heating up, more cars on the road leads to a higher frequency of crashes. So we're going to be paying more. And so there's an actuarial debate about where your future trends are going to go. There's also the question of you have a bunch of claims now. Are they going to mature higher than they are, lower? Are you going to be paying more for those existing claims? And so you also have to tell the department about, we think our existing claims, by the time we finalize them, they're going to really jump in value or not. And so you argue about that as well. And so honest people can have differences of opinion when you're talking about actuarial judgment and what you think the future will be. And as a result, you've got analysts and actuaries at the Department of Insurance who would look at the same data as a company actuary and say, we don't agree. We don't think that inflation's going to go up so much, so we're not going to let you charge, more or as much as you want. And so that process, even though the law says any rate approval not approved within 60 days shall be deemed approved, that's not the way the law actually works in practice. On day 59, the Department of Insurance will tell an insurance company, we're not ready to approve it in 60 days, and if you don't waive your right to that approval within 60 days, we're just going to send you off to litigation, and we're going to get an administrative law judge appointed, and we're going to litigate this matter. And that's going to be a year anyway. So every company, as a matter of course, waives their right under the law to a 60-day approval. And so how long does it take? Well, in a good circumstance, probably 6 months. There are, of course, terrible cases of 2 or 3 years of a rate filing languishing, and it's hard to pinpoint the reason. The people at the Department of Insurance, they have a heavy workload, and they're trying their best, and they feel like they've got this charge to protect people from higher rates. So you understand where they're coming from, but there's a price to be paid for being over-aggressive in holding rates down. Because then if it takes a long time, by the time a company gets maybe half of what it requested, if that took a year, they're just going to turn around and file a rate filing again. And in the meantime, they probably won't grow and they might even shrink. So there's a push and pull.
So they're not writing policies, and then people have to go to FAIR Plan. Now, is there a model where the profits of these companies is calculated? Is there a cap on how much you can make?
There's a profit cap in the regulations, and it varies depending on the then present value of different fixed income instruments. It's a complicated formula, but there is a profit cap in the regulations. And importantly, the way the law works is the higher investment income a company makes, then the lower rates they're permitted to charge. So if someone wants to say, oh, those insurance companies, they're making all this money in the market, blah, 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 they can say that, but then they have to charge less. They have to charge less.
The regulators will come and see that income and say, you have to give that money back.
They can't say give it back, but they can say you have to, going forward, you have to charge a lower rate. So the way the law works is it says no rate shall be inadequate, excessive, or unfairly discriminatory. It says no rate shall be approved nor remain in effect. And so the Department of Insurance at any time can come to a company and say, well, we've been looking at your data the last couple of years and you've paid out very little and you've made a whole bunch of money, and they can order you into a process where they order your rates down. And that does happen. I know it's easy to be angry at big premium increases that you might have to pay to an insurance company, but it's the most rigorous system really in the country. And the Department of Insurance at any time can challenge a rate that's in effect, and outside groups can. They can petition the Department of Insurance saying company X, they should be charging less, and the department has to look at that. And so it's a robust price control system that's really unlike any other state, and it takes a really long time to get through the process.
Rex Frazier, California insurance expert, it was great to have you on California
Thanks for having me back. I appreciate it.
We hope that these damages will go away, and this is the last time we're facing something like this.
Well, I hope next time we meet, my report will be a little rosier.
Let us know what you think about the insurance situation in California. You can email us at siamak@californiainsider.com or comment. We read all of your emails and comments. I'm Siamak Karami. This is California Insider. We'll see you next time.